So what we're going to do now is we're going to delve into the realms of private equity and private credit. And of course, many of you have been in this sector for a long time, but also you've been operating from this region for quite a long time. So what I'd like to do is sort of, in my sort of normal approach, get you to give us a feel of your journey to this point, coming into the region, and your activities in private credit. If you could give us a bit of a highlight.
Me first. So hi, I'm David. I'm partner.
That wasn't me.
I'll try again. I'm partner at SE Low. We're a $3 billion banking and asset management group based out of Hong Kong. We run strategies in secondary and private credit across Asia Pacific, Middle East, and Europe. Middle East has been a really fascinating time for us. We started investing here in 2011. We've been involved in 33 different situations over that time period, investing around $600 million. We have concentrated, and there's a reason for this, we've concentrated on large debt structures where we're entering the credit structure as a secondary participant. So effectively, we're buying from existing bank lenders. The reason we haven't followed the private credit space to date, and that will change, is because the legislation and the ecosystem and the attitudes of the region weren't as developed as other markets that we operate in, like Europe and Asia, where we run very strong private credit, special situations, strategies, senior secured, sort of mid-teen plus returns. We are now dramatically seeing a change in all of this in the Middle East. Very exciting. The legislation, the bankruptcy laws, the restructuring, the ecosystem, the attitudes is dramatically changing. And as a result, we are looking to replicate our success in private credit in special situations in the region and based on our track record over the secondary side of things.
Sounds great. So you're here.
We're here. We've been investing here for over 12 years, but we will be developing and launching funds dedicated for the region.
And Vanessa, what's your sort of journey to this point? You know, you've been operating for a long time. You're on the ground here. What's the story so far?
I think the story is to bring Asia to the Middle East and to bring Middle East to Asia. So I was the first investment officer of Capital Group, which was one of the largest American asset management company in the emerging markets private equity fund before I started my own OCIO, which is the first independent OCIO based in China, Hong Kong, to invest globally. So we are allocators as LPs to global private equity and private credit and venture capital, and we invested in the Middle East, in Indonesia, Vietnam, India, and of course China, and understood the emerging markets joys and pain of allocating to both private and public asset classes. And I see great opportunities in Asia that this region has strong interests, but not yet captured. So that's why we are here.
I think I think it's interesting because all of you have been operating different regions, and Omar, I'd like to sort of get your feel for some of the main differences between the West and US-dominated activities and this region. What's your sense of the differences there?
Thank you for that. Good afternoon, ladies and gentlemen. Omar Liao, Vertia Partners, the region's first partner-owned private credit firm here based in ADJ Abu Dhabi. One of the first things we need to demystify about private credit in the region versus our friends in the West, as well as the East, is that this is a non-sponsor-led market. What I mean by that, we're not waiting for private equity transactions for us to help them through providing these loans. We actually interact directly with the underlying companies throughout the Middle East and North Africa to provide flexible capital so they can continue growing. And now for a region where we all know there are a lot of banks, for example, in UAE alone, there are 54 banks. Some people wonder, well, why do we exist? Why don't they just go to the banks? Is there something wrong with these companies? And the answer is, no, there isn't anything wrong with these companies. The real challenge is the banks in our region, not just UAE, Saudi, Kuwait, and others, they give the least amount of money to, or loans to mid-market companies, which is what we target. There was a World Bank report that came out a few years back that looked at all the banks globally, as well as the ones in the Middle East, to see what makeup of their loan book is toward the SMEs. Now, we don't do the S, but we look at the M. And what we found that in the GCC specifically, the loan books, on average, for all the banks here, how much they give to mid-market or SMEs is less than 2%. Whereas if you compare that with banks in the West, it's around 22%. So that gap provides opportunities for us, a humble small team of 6 people, backed by the likes of Mubadala Capital and other institutions, to actually give flexible investments to companies that need to grow. Versus in the West, you're waiting for PE. That's one of the examples, but we can talk more.
Yeah, we'll dig into a bit more of that in a second. And I want to bring in Tarek here. What are the things from a private equity point of view that is special about this region compared to others?
Well, thanks for the opportunity. I think there has been significant changes in the private equity landscape in the region over the past few years, especially after the fall of Abraj, unfortunately. And if you try to split that landscape into like industry players versus deal flow versus future outlook, it's very clear. So it has revamped recently. When you look at industry players, you have the private equity investors or the GPs who are now becoming more and more sector focused. They're shying away from the traditional approach of generic investing. You see a lot of family offices that are deploying more capital in the region, either through direct sort of funds or direct investments or co-investments. And the most interesting part that you're witnessing here is the sovereign wealth fund. They're significantly increasing their investment activities in the region, which is for us, we're so glad to see that. Deal flow in the region, east, west, compare here. If you look at the global landscape last year, unfortunately, given the negative sentiment in the global economy, M&A activities declined significantly, both in volumes and in value. But if you look at the Middle East, actually, we've pretty much maintained a flat trajectory. And again, that was very much fueled by the surge of investments from sovereign wealth funds and private equity investments. If you shift slightly to sort of outlook, I think, Saudi, as Omar said, Saudi and the UAE will continue to lead the pack, continue to be the engine of M&A activities in the region. And I think the only thing that differentiating here in the region is, I would say one would clearly have to wait and see how or if the unfortunate geopolitical tension in the region will impact the industry. But personally, I think private equity will continue to grow significantly over the next 3 to 5 years in this.
Yeah, interesting. And Muto, I guess that you bridge the divide with your family office hat on. How much are you influenced with the positive activities in this region, with where to deploy your capital, whether it's going down the credit route or whether it's going down the private equity route? What's your sense?
So for us, we are pretty new to the region here. We run a global mandate when it comes to our private markets, specialization in private equity, although we also look at private credit. Within the global mandate, I would say that Middle East or GCC falls within the Asia bucket. So that's where we would evaluate managers coming from the region. So far, we've not had a manager make it to the 1 or 2 seats that we have for an Asian manager per year. So for us, it's pretty new. We're also exploring the region here to see whether we can actually help fellow family offices with their private equity exposure or private markets exposure. So that's one of the roles that we took in Singapore, which is where we're based as a family office, where we brought, I guess, a bit more of a Western outlook and setup for a family office. So slightly more advanced, and brought it to a more nascent system in Singapore that has been strongly developing. And my sense is that the atmosphere here is pretty similar to how it is in Singapore, give or take maybe 1 or 2 years. So we are exploring whether we can take a similar role here as well. Whether we would look specifically at funds targeting GCC, who knows? If there's great track records and great teams out there, there's no reason why we wouldn't. But so far, we haven't seen them on the radar yet.
Yeah, and I guess also, Vanessa, you're quite keen on, it's the opportunities in to sort of push the private credit versus the exit options available in private equity. What attracts you? What are you looking for in this space as the next move that you can exploit? I mean, where do you see the opportunities?
Well, before talking about opportunities in the cycle, I think there are three very important backdrops to think about asset classes, which is the 40-year long of interest rate, the dropping cycle has turned. And in this interest rate dropping cycle, people tend to be less invested in the balance sheet and less invested in the cash flow and more invested in the long duration future growth. So that's the general construct in the last 15 years post the GFC. So now that's reversing. Then when we look at the private credit versus private equity, the younger vintages of the private equity at perhaps the average quartile up below 25% is gonna likely go through a very, very strong reckoning with that factor concentration of growth and long duration growth, particularly the underlying founders of company operators of late the recent 10, 15 years tend to less focus on bottom line and cash flow growth and more focus on revenue and market share expansion. And that kind of investing mentality has to change. But in Asia, where we see private credit play a very helpful role, is one that Asia still provides a lot of growth, but there is no one Asia, and many of the Asian countries, actually the domestic market still remains small. So private credit actually provide that financing needs for the founders in this challenging valuation environment for them to grow. So we recently deployed into a Southeast Asia private credit that is specialized in funding the founders to run their companies when capital becomes expensive and scarce to raise. So that's one of the functions of a private credit in this cycle. Another one is, particularly in China, we see perhaps one of the best distress cycle that's coming up.
It's one of those things that I've always thought about, private equity in a sense that, they're always looking for, specialist opportunities. I mean, whether it's to use a rising or falling economy to jump in at a point. How do you decide in these sort of market cycles where the opportunities sit, whether they're distressed or whether they've got upward or downward momentum where you can jump on the back of it? I mean, how do you make those judgments?
So we are pretty sector agnostic. We will follow the opportunity set as they come up. A good example was in sort of 2013-14, there was a big shipping crisis. So we made a lot of investments within the shipping sector at the bottom of that market and have largely come out with some very strong risk-adjusted returns. Shipping is a good example of a type of sector that we like because we like hard assets, we like security. Our role in distressed and special situations is to protect our downside. So we like that kind of hard asset class and that security. We like that in our secondary activity and we like it in our private credit. Geographically, again, we'll follow where the opportunity set is. And what we find is that the market moves, but if you're consistent across those markets over time, you'll consistently make strong risk-adjusted returns. And LPs appreciate that consistency. The market appreciates that consistency. Another good example is what we've done in the Middle East. We've been investing here consistently since 2011. We are well known. If a bank is looking to do something, if a corporate is looking for a new money solution within a restructuring, we're likely to be part of that because they trust us and they know we're consistent in our approach.
Yeah, I guess what if Omar? I mean, if you're looking to exploit opportunities on the back of these, cyclical events and economic situations. What are the things that you look for specifically that drive some of your decision and your behaviors?
Great question. We are looking after companies that are growing in the Middle East and a bit of North Africa, but really companies that are doing well. They need an extra 3, 4, 5 years, depending on the type of loan. Usually it's about a 5-year loan to help them continue to grow or do maybe a management buyout. Now, the real question is, why are they not able to get that money from the banks? And the Middle East doesn't have a money problem, as I was alluding to earlier. It has a human capital problem. And what I mean by that, the banks that have a loan officer that wants to go to an entrepreneur that's doing a phenomenal job at his company that he or she started, if he or she are not from a large family, whether it's in UAE or Saudi, so name-based lending is quite prominent, or if they're not doing any direct government projects, the chances are that that loan officer will not even take that loan to the credit committee. That loan officer, if he doesn't know the name of that family, doesn't know if the project is well known and well publicized, doesn't even take them to the IC. So what you're finding is that you're finding opportunity sets where companies that are actually viable, growing, and their only other choice of flexible capital that we provide other than us is to dilute their equity further. And as a business owner, you don't want to end up owning only 5% of the business you started. And that's really what's been happening over the last 15, 20 years, with the exception of a few instances where credit managers like ourselves have been able to help companies. The other thing that you're actually seeing that's quite interesting is that sovereign wealth funds and pensions, the ones who can support this industry, for the first time over the last couple of years have actually started allocating to managers similar to us and others, which they've never done before. That gives family groups in particular the comfort to know that, okay, if the sovereigns who allocate the credit globally as well as now regionally are doing regional, they're not doing it as a token investment to us. They're doing it because they're seeing a serious opportunity set that's untapped. And that's what we're seeing. We're seeing over $2 billion of transaction every single year. And again, we're humbly only 6 folks at this time. So the opportunity set is huge and the companies are growing. Now, unlike our friends in the West and East, we really don't look after distressed companies. Typically, if a company is distressed, it's not the same as it is in Asia or in the US or in the West. It's usually their cap structure is inefficient. It's not that the company is going bankrupt. So when people think we're getting double-digit returns, they think, what's wrong with this company? Nothing. The banking is the issue. The banking simply doesn't allocate to folks who are not from big names or folks who own land and buildings they can lend to the bank.
So from a sort of an allocation point of view, when you're trying to entice families or you're looking at how the families are making their decisions right now, how are the families driven? I mean, how are they making those allocation decisions, do you think? I mean, and what do you need to do from a private equity point to pull more of their capital into your world?
Yeah, I think, I think we're competing with you because of those companies cannot get debt. They usually come to private equity and they have to dilute themselves. But it also goes to your point. I think most of, this is a region that is very much focused on family businesses that drive the economies. So most of our investments, actually not most, all of our investments for the past 10 years have been in family offices or in family the family-led companies. And the formula for us, at least it's clear. You have to show value add. The days of just investing, through cycles and come in at, multiple 10 and exiting multiple 15, those days are gone. You need to create alpha. You need to roll up your sleeves. You need to do proper portfolio management. We do a lot of focus, our mandate, so just quick background, Affirma Capital is a mid-market private equity platform. We're headquartered in Singapore. We cover Middle East, Africa, and Asia. And I cover the Middle East out of the office in Dubai. But in the Middle East, our mandate is very clear. We invest similar to Omar in mid-market, strong companies. And the goal is to grow these companies in terms of product portfolio, in terms of geographical footprint, in terms of profitability, just to make them attractive enough and ready for an exit to a larger, private equity player, or to be ready now. We see the capital market is improving and get them ready for an IPO. So I would say everything that we do is with family-led offices. And on the fundraising side, you're seeing a lot of family offices already being more interested and engaged in private equities. And I said, we see a lot of involvement. Actually, at Firma Capital, we're launching a GCC-focused private equity fund, and for the first time in the history of our organization, we're actually carving out part of the fund in terms of allocation for family offices. So, and you see a lot of family offices that's probably here today, establishing their own PE shop and their own sort of boots on the ground. So it's also back to your question, what has changed? A lot has changed over the past 10 years or so.
And Walter, what about exits? What about, because you're reading quite a lot of stuff that the markets are slow. If you want IPO, there's a huge list of companies waiting their time. What about exits? I mean, it's tricky right now. When are we going to see? I wouldn't say the good times come back, but when are we going to see the exit options appearing?
Yeah, I think, on the exit side, it very much depends where you sit. So I think some of the most difficult areas are obviously tech, but also the firms owned by the mega cap or large cap PE firms, so the ones that indeed depend on IPO markets as a means of exit. Where we see a better environment still for exits is more in the middle and small cap side of private equity, where these sponsors typically sell to the larger sponsors, so there's still an active market there. We still see strategics being active from an M&A point of view. Obviously, the exit markets are not what they used to be, so it is slower. But for most of our funds, we do see active exit agendas, actually. And another way to play the current system is to play in the secondary fund space. So we've seen a lot of fundraising in the secondary space. And I think this is the ideal time for secondary funds to prowl the market and get great deals, because there's lots of funds that indeed struggle with these exits or need to set up continuation vehicles for older assets in older funds. So one of the ways that we try and benefit from the current situation is actually over-allocate in the secondaries space. Having said that, the secondary players themselves also at times struggle. I had a conversation about it yesterday with one of our secondaries managers, where they also see slower exits of their own portfolio, right? So everybody is suffering a little bit, and to your point, when will the good times be back? If I would know that, I wouldn't be here on panel, I guess, right? I'd be banking in on that.
And Vanessa, I mean, you're operating in a slightly different geography. I mean, how do you see, the options opening up for you in this,
Although we operate out of Asia, we are actually very optimistic about the opportunities in terms of deployment in the Middle East. We are one of the early Asia institutional allocators investing a few venture capitals from Israel and also in the UAE as well. The reasons being, we see from the real world perspective, a lot of industrial and consumer companies now, because of the difficulties of the decouplings and the supply chain movement and all that, because of UAE has a trade agreement with many countries to dock into Europe and Africa and India. So a lot of Asia, traditional Asian-based large industrial companies are actually footprinting deeply their base using the UAE and the Middle East region in general for them to further globalize into the vast market of Africa. And for example, I just introduced Hisense, which is the second largest display company next to Samsung in the world, to start one of their largest investment base in Egypt. But that kind of another wave of industrialization brought local middle income formation, brought local consumption, brought local services providers along these mammoths of industries in the Middle East region. And we see opportunities from new energy, smart logistics, smart living, etc. In the Middle East locally coming up. So that's why we invest, and particularly a lot of the R&D efforts are using UAE as a base to proliferate into European and American downstream applications, and we invest in the upstream venture capitals in those funds as a indirect way to tap into the end market in North America. So those are the areas that we are looking at the Middle East. And the local stock market, maybe we look at it from the outsider standpoint. The local Middle East market actually, I think Saudi and Abu Dhabi Stock Exchange both rank among the top 10 IPO market this year. Although Saudi and UAE economy in terms of the total GDP were both not in the top 10 GDP, which means the local stock market in a Warren Buffett ratio, the market cap versus GDP actually is disproportionately higher than other regions. So that in terms of the exit, we are looking at potentially the companies from this region do not necessarily need to go to US or other or Europe stock exchange for exit. It can exit with at the local stock exchange funded by the local dollar liquidity. That's the thesis that we are looking at.
I think it's quite interesting to look at what can we expect next over the next 12, 24 months. I mean, you're probably assessing all sorts of options. What's your prediction over the next 12, 24 months, and where you can play, and how everything is going to sort of roll out for you?
In this region or across our portfolio?
Well, yeah, this region and any other region that you have a particular viewpoint on.
Yes, it's obviously a very interesting time. Europe is where I'm sat in London. We have an ADGM office, but I'm sat in London. Europe is seeing a huge amount of distress. There's a huge amount of economic headwinds. They don't have the benefit of the growth that we're seeing in this region. Everything is on the down cycle. So the next opportunities there are going to be more in that stress restructuring space. There's a lot of opportunities that we're seeing in Europe in mid-market special situations, private credit, where we're lending to mid-market companies that are starved of liquidity because banks have pulled back from that sector. There's a huge amount of, there's large multi-billion dollar funds looking at the space who are looking at $100 million tickets plus. So even the private credit market is neglecting that mid-market. So that's where we see the real opportunities in Europe. In Asia, which is much more illiquid, there are opportunities because the banks, again, have retrenched from certain sectors. We're seeing huge opportunities in India and South Korea in particular right now because of the stage we are at the cycle, where we're picking up a number of percentage points of yields for senior secured risk because the banks have retrenched. We know that in a couple of years that'll come back and we will effectively get a yield squeeze, and that's a good exit for us. In the Middle East, as I mentioned at the beginning, we're incredibly excited about what's happening here. There is almost no private credit market, right? We've got the likes of Ruya Partners, there's a couple of other fund managers, but there's very, very little alternative private credit. The environment here and the legislation and everything else I spoke about earlier is incredibly exciting to create that market. It's going to take a bit of time. It's going to get, the ecosystem has got to develop. We're going to have a huge amount of teething issues, right? Which we're witnessing in our current investments in the region. But if you even visualize forward, as you say, maybe a couple of years, maybe a little bit longer, if this market even approaches a small percentage of Asian private credit market, let alone Europe, let alone the US, which is a multi-trillion-dollar industry, even if this market approaches a small percentage of that, it's going to be a multi-billion-dollar industry. Yeah. And we find that incredibly exciting. As I say, we've got over a decade of experience in credit in this market. That combined with our private credit experience, we feel is a good combination to be able to explore this market and grow this market. And we're seeing that ecosystem listen. We're having consultation with key people. I know that the likes of Ruya are doing the same and really building this market and in attracting LPs to this asset class. I mean, I could go on and on how excited I am about the region, but I think you've got the message.
And Tarek, I mean, where do you see the opportunities and over the next sort of 12, 18 months, 24 months?
Yeah, if you allow me just a few seconds on exits, because I've been covering private in this region for about 13, 14 years now. And I have to tell you, the first 10 years were just awful, painful, no exits, no M&A sort of, there's no private equity. Private equities would never buy from private equities. There's an ego thing going on. The capital markets were not suited enough for PE transactions. But I think that's really changing over the past sort of 3 or 4 years. Capital markets, like Vanessa said, now in the UAE and KSA are really turning around. If you look at the number of IPOs in both countries, nearly tripled over the past sort of 2 or 3 years. Saudi in particular, it's number of IPOs in last year, I think compared to the year before, was about 5x if you include the Namu listing. So the sovereign wealth funds investments that Omar alluded to earlier, that's also moving the market. So we are seeing a transformational change in terms of exits. And for us, again, we went from a painful period to our investment thesis in terms of exits is really changing. In terms of outlook, Nick, I think I'm personally super optimistic. This is an industry that's underserved in this part of the world. Again, the involvement of sovereign wealth funds, it's sort of bringing life to the industry. And I think there's going to be, significant growth in this industry over at least the next couple of years.
And Omar, how do you go about targeting, the deals that you want to get involved in and securitizing those? How do you see the opportunities? Because nobody's really saying a bad thing about this region. Everyone's saying it's doing fantastically well. How do you go about targeting opportunities?
Interestingly, because of the space that we're playing in has very few seasoned investors that are doing it from their own investment house, i.e. they're owners of the business themselves versus working for perhaps a bank or perhaps a family group. We're seeing a lot of the advisors that have the ears of these underlying investment companies in Saudi, UAE, and other places. They primarily come to us, as well as we sometimes go directly to companies that we like. Just based on that alone, we're getting so much traction on companies that in the past never thought about going through the private credit mindset because they thought on a sticker shock it's higher than a bank lend, but they can't actually get access to that bank lend. So we're getting a lot of inbound, as well as we sometimes target particular industries. Now, while we look at MENA in general, the lion's share of where all the transactions are coming, to no surprise, is UAE and Saudi. We are witnessing a renaissance that hasn't been witnessed since the discovery of oil in our region, led by the UAE, led by Saudi. The real question as an investor, all the investors that are sitting in the audience is, how are you participating in this? Aside from your core businesses, aside from allocating to international managers, there are opportunities here that are more secure, and we can talk about being able to have a lot more securitization of the credit here. Now you have ADGM that actually have a private credit regime, whereas before you couldn't actually have a private credit firm. There was no rules to have a private credit firm. We were one of the first firms to get that license early this year. So and the real question then becomes, as investors, what are you doing to actually access that growth toward these various vision plans? The big visions, the big mega projects are already being funded or partly funded by the government and international banks. It's the mid-market. Part of that vision, whether it's UAE or Saudi, requires that the middle class grows even further and stronger. And it's these investments that we humbly are finding that are enabling part of that growth. It's not just the mega projects. And how do you access these? And we're one of the few that can do that.
And Wouter, where do you see the opportunities? What are you looking for, and what gets you excited?
So for us, 2024, I think, is the same year as any year before the years after. So we manage our strategic asset allocation with a 35-year target. So short-term volatility to us is not a measure we take into account. So our methodology is to build a proper private equity portfolio or private markets portfolio. You need to allocate through different market cycles, so to avoid any vintage that might be bad, right? So you want vintage diversification on top of your geographical or sectoral diversification. So we will do more of the same in 2024 as in years prior. But then, that would not be a nice piece to leave the audience with, right? So it is quite clear, and it's probably one of the reasons that the topic also includes private credit, that credit, and specifically private credit, currently is a hot topic. And there's good reason for it. So We currently see private credit at levels where it surpasses historical levels of equity returns that one would expect to get in liquid equity markets. But you now get equity style or superior to equity style returns for private credit, which comes at a very different risk profile from the liquid equities that you would have in your books, because obviously credit sits senior to equity in the cap table. So whether we're heading towards very positive years or towards troublesome years, sitting senior in the cap table will set you up better, I guess, from a security point of view. And one of the good things about private credit is that if you can get a 10 or 15 or whatever level of credit return, that is not a question mark like return like the historical 8% for equities. That is a contracted rate. So I can completely understand why people currently are very active and excited about private credit. We share that enthusiasm, but still feel that we need to invest through cycles. So also in this year, we will invest in private credit, but so did we do last year. So for us, not much changes, but credit is definitely one of the items to look at. Maybe 2 words about private equity. I feel that at the larger mega cap side of things, managers there will struggle because quite often their business model depends on leverage. The leverage for them is currently just unaffordable. I think within private equity, the mid and smaller managers can still do well, but the mega cap and large cap, from my point of view, are areas that people should avoid in this pricey credit environment.
I guess you know, the private equity, I mean, is it fair to say that it really hasn't changed its model for quite a while? In your view, you know, and this is sort of a quick thought for each of you, what's the opportunity for innovation in private equity? You know, I mean, private credit, I mean, we understand, I think, the reasons why it's become a strong option. But what's the opportunity for innovation? I mean, Omar, you have what's your thinking? Is there an opportunity?
There's an old saying, if you don't continue to grow, you die. Frankly, I think technology enabling deals to shrink in time to execute. What I mean by that, while we are private credit, not private equity, we apply the same metrics of private equity investing, i.e. it takes us from first handshake to final investment about 6 to 7 months, because we get to meet the founders, we break bread with them, we do our own internal due diligence, we bring external DD providers like financial, commercial, and legal. But that time frame and the various data points that the companies give us, sometimes they're not in a uniform way. That time, I think technology is going to help shrink that further. There's some various technology that's available for the S part of the equation, but for the M, there hasn't been that much development yet. I think that will enable us to deploy money faster, but still adhere to the strictness of our diligence process. That, I think, would be fantastic for us.
And isn't that, Tarek, part of what some of these emerging platforms are meant to do, is to take a lot of that friction, time, and effort out of the process, so you can get a look at a lot more deal flow and make a call on it? I mean, what's your view, Tarek? I mean,
I'm really sorry, I didn't hear the question.
So isn't the concept of, I guess, largely what Omar is saying is that the automation and using technologies to speed up the process so you get a much better look at more deal flow, that's the role of a platform, isn't it? I mean...
Absolutely. No, absolutely. I'll tell you, over the past few years, innovation and automation, this has been every time we do an investment, there's a 100-day plan. And I can guarantee you over the past 5 years, innovation and automation, it's been a core part of that 100-day plan. Every portfolio company that we have, we're introducing tech-enabled, something to help them, whether if it's an FMCG company, tech-enabled sort of sales force that helps us track, sales and grow sales and track, the activities that we're doing. So that is becoming a cornerstone of anything that we do with all of our portfolio companies. Absolutely.
And David, is the innovation, is it around a lot more automation so you can get a much better look at more stuff. I mean, you operating in multi-region. I mean, each region has different rules, different profiles, and what have you. I mean,
yeah, on the more liquid product, some of our parts of our secondary portfolio, like high yield bonds and so on. Obviously, there's a lot of the technology comes into the trading aspect of those instruments. When we come down to the more illiquid side, it's more down to manual and relationships. It's about knowing and trusting your counterparty rather than having a platform showing you every deal, because a lot of what we do, you don't necessarily want the world to know, right? The corporate that needs liquidity doesn't necessarily want the world to know that it's struggling for liquidity. And they want to work with a partner that they can trust and have the relationship. Likewise, if a bank is looking to sell their position at a discount, they don't want the world to know that they're doing that, especially if they're in negotiations with the corporate. So it comes down a little bit. The tech is less in most of our business, but certainly on the more liquid side of things, even in the loan markets in Europe now, you're now getting platforms where there's anonymous posting of loans for sale, right? Or NPL portfolios. That's where the technology is coming in, where it's a bigger market. And maybe that will come into the emerging markets, but to date, I think it's going to rely on those relationships and the more manual process in our world.
The time is timing up. I just wanted to mention one very strong trend we see from Hong Kong. It tries to be a Web3 economy hub, and the technology, particularly blockchain technology, is hybriding with the traditional asset classes to form a new hybrid asset classes on blockchain of providing balance sheet-based yield, real-world assets to the financial world. And we're innovating that with infrastructure providers such as Coinbase, etc., to bring that asset portfolio to this region as well. So that's how asset class mixed with the blockchain.
I am also a fan, Vanessa, of the tokenization of the world. So, removing that friction time cost, out of everything, being able to trade anything and everything on. Well, let's see how that plays out. Anyway, look, I think we're out of time. You've done very well on the first panel after lunch because everyone's a bit sleepy. So thank you very much, and give them a good hand.